Okay, let's just jump right in. The idea, putting half your net worth into just 5 companies. I mean, wow. That sounds intense.
It definitely grabs your attention, doesn't it? It flies in the face of, conventional wisdom about diversification.
Totally. Spread your risk. Don't put all your eggs in one basket. Or, well, 5 baskets in this case.
Right. So what's the thinking there? Why so much conviction in so few stocks?
Exactly. And that's what we're really digging into today. It's this specific, very high conviction dividend investment strategy. We're looking at someone who's actually shared their portfolio, their why.
And just to be clear for everyone listening, this isn't about saying go do this. It's more about understanding the philosophy behind it. What makes these specific 5 companies tick for this investor?
Yeah, what gives them that confidence for, steady income, long-term resilience, all that good stuff.
So our mission really is to unpack the principles. Why these 5? What's the financial faith, as they call it, built on?
Okay, so that term itself, financial faith, putting 50% in these 5, what does that signal about their approach? It sounds different.
It really does. It suggests they're not just like chasing the latest hot stock or trying to time the market.
No, it feels much more long-term, deliberate, like building something solid, not just speculating.
And the focus on dividends is key here, right? We're talking about companies that consistently pay out cash to shareholders.
Uh-huh. So it's not just hoping the stock price goes up, but getting that regular income stream.
Exactly. That income, plus the potential for the company itself to grow over time.
Mm-hmm.
And they seem really focused on compounding.
Right, the magic of compound interest. Reinvesting those dividends, letting time do the heavy lifting. It's a slow burn, but powerful.
And that leads to this idea of concentrated dividend investing. Basically, they're arguing quality over quantity. Know a few great businesses really well, rather than owning a little bit of everything.
Fewer, better bets, essentially. Okay, so let's get into the specifics. The famous 5. First up, Johnson & Johnson, J&J. They call it the sleep well at night stock. Why?
Well, for starters, it's about 12% of this person's net worth,
Yeah.
yielding around, 3.2%? But the big thing is it's history. It's a dividend king.
Dividend king, meaning?
Meaning they've increased their dividend for over 60 years straight.
Yeah.
60. Think about all the recessions, the crises.
Wow, okay, 60 years of raises. That's stability personified almost. How do they manage that?
It comes down to their core business. Healthcare is generally defensive.
Mm-hmm.
Even with spinning off the consumer side, Kenvue, and dealing with those talc lawsuits,
Mm-hmm.
their main engines are pharmaceuticals and medical technology. Think drugs for immunology, oncology, surgical robotics. These have deep moats.
Deep moats, like strong competitive advantages.
Exactly. Patents, scale, R&D. It's hard for others to compete directly. And then there's the balance sheet.
Ah, yes, the credit rating. They mentioned it's AAA.
Yep, AAA. Which, believe it or not, is higher than the U.S. government's rating.
Right.
That just screams financial strength and low risk.
So you can see why it's an anchor for the portfolio.
Yeah.
Okay. Makes sense. Next, PepsiCo.
Right, PepsiCo. About 10% of the portfolio, yielding around 3%. And the key point here is it's way more than just soda.
Yeah, they really emphasize that. It's Lay's, Doritos, Quaker, Gatorade, a huge food and beverage company.
And that diversification is crucial. If soda sales dip, maybe snack sales pick up. It smooths out the cash flow.
Less reliance on just one category. And they're also a dividend veteran, right? A dividend aristocrat.
Correct. Over 50 years of dividend increases for PepsiCo.
Yeah.
Shows the consistent profitability, that brand power.
Yeah.
They target like mid-single-digit growth, stable margins.
It works. And they argue it might be more future-proof than, say, Coke because of that snack business.
That's the argument, yeah. Plus, they've been pretty reliably hiking that dividend, often 7 to 10% a year.
I like the analogy they used, the moat being like emotionally eating Ruffles during a market downturn.
Yeah.
It makes the concept very tangible.
It does. It highlights how people keep buying these products almost instinctively, no matter the economic weather. Comfort foods, right?
Right, totally. Okay, number 3, Realty Income, ticker O, the monthly dividend company. This one's a REIT.
Yep, a real estate investment trust. Yielding higher, around 5.9%, also at 10% of the portfolio, and its niche is very specific.
Which is?
Single-tenant retail properties under triple net leases. Think Walgreens, 7-Eleven, Dollar General type places.
Triple net. Remind me what that means again.
It means the tenant is responsible for basically all the property expenses. Taxes, maintenance, insurance.
Ah, okay. So Realty Income's main job is just collect the rent.
Pretty much. And they do it very reliably. They boast over 600 consecutive monthly dividends paid and over 120 dividend increases.
Monthly dividends, wow, that's consistent income. How do they keep that up?
Focus. They lease to stable tenants, often in essential retail, on long-term contracts, plus geographic diversification and really high occupancy, usually over 95%.
So it's deliberately, well, boring, predictable income from real estate.
Exactly. They contrast it with speculative development. This is about steady, reliable rent checks.
Got it. Okay, moving on. Number 4 is Brookfield Infrastructure Partners, BIP, yielding around 5.5%, 9% allocation. This one sounds different. Global infrastructure.
Yeah, much broader scope. They own essential assets all over the world. Toll roads in South America, pipelines in North America, cell towers in Europe, railways in Australia.
Wow. Okay, so diversification is built right in geographically and by asset type. What's the appeal?
Well, infrastructure is essential, right? Often long-term contracts, sometimes regulated returns, which means potentially stable cash flows. Plus, they're managed by Brookfield Asset Management.
Who are known for?
They're like global leaders in alternative assets, especially infrastructure. Their strategy often involves buying assets that might be undervalued, fixing them up operationally, and boosting the cash flow.
Okay. But there's a catch, something about it being an LP.
Yeah, it's a limited partnership. So instead of a standard dividend form, investors get a K-1 tax form.
Which means taxes are a bit more complicated.
A bit more involved, yes. But the trade-off is potentially higher yield and exposure to these unique, hard-to-access assets. And there's an argument that global infrastructure needs significant investment going forward.
Interesting. Okay, last one, number 5. Texas Instruments, TXN, yielding about 3.4%, 9% holding. This is the tech play, but not flashy tech.
Definitely not flashy. TXN makes analog and embedded chips. These are the workhorse chips, not the super high-end processors you hear about.
So like chips that go into cars, factory machines, HVAC systems, appliances, that kind of thing.
Exactly. Boring but essential, as the investor calls it. They're everywhere, even if you don't see them.
And how does boring translate to dividends here?
Because demand is broad and relatively stable. These aren't fad products. They have long life cycles. This creates consistent profits and, crucially, strong free cash flow.
Free cash flow, the cash left over after running the business and investing.
Right. And TXN is famously disciplined with it. They invest smartly, buy back stock, and have grown their dividend massively, like over 600% since 2004.
600% dividend growth for a chip company. That's huge.
It is. They explicitly commit to returning basically all their free cash flow to shareholders via dividends and buybacks. The investor called them a cash flow machine with an engineer's temperament.
I like that. Focused, efficient, reliable.
Precisely. They stick to their knitting within the semiconductor world.
Okay, so that's the 5. Looking back across all of them, what are the big takeaways, the common threads in this strategy?
Well, first, this idea that dividends buy time. Getting that cash flow, especially when markets are rocky, provides a buffer. It's psychological, too.
Yeah, seeing cash arrive regularly feels different than just watching a stock price bounce around.
For sure. And then there's the relentless focus on free cash flow. All 5 are cash-generating machines, and they prioritize returning that cash.
It's not just about earnings per share, but actual cash coming in and going out to owners.
Exactly. Another point is understanding the business, not just the stock ticker. Knowing what they do, how they make money, their competitive edge, the management.
Right, buying a piece of a company, not just a symbol on a screen. And the stick with boring theme definitely comes through.
Less hype, more fundamentals. These aren't necessarily the companies grabbing headlines, but they're often the ones steadily compounding wealth and income.
So why does this investor trust these 5 so much? What's the deeper rationale for this financial faith?
They seem to see it as finding financial truth in a world often driven by speculation. These companies generate real income, grow it steadily, and focus on consistent operations.
It's positioned as deliberate conviction, not just a random, YOLO bet.
Absolutely. The goal seems to be long-term income, predictability, and gradual wealth building through ownership of quality businesses.
So, summing it all up, this deep dive really highlights a strategy focused on concentration, dividends, and deep business understanding. Picking a few strong, cash-generating companies and sticking with them.
And for you listening, the key lessons might be the importance of looking beyond the hype, really understanding what you own, valuing that free cash flow generation, and appreciating how consistent dividends can contribute to your long-term goals, even if the companies seem a bit, boring.
Yeah, maybe boring is underrated in investing. Okay, so here's something to chew on. What level of conviction, personally, would you need to put so much capital into just 5 names? Forget the spreadsheets for a second. What non-financial factors build that kind of trust, that financial faith?
And maybe think about it this way. Are there any boring but absolutely essential industries or companies out there, maybe ones you interact with every day without thinking about it, that might offer that kind of long-term stability and income potential you're looking for? Something to consider.